Welcome back to the Deep Dive. Our mission today is really laser-focused. We're not talking about gathering the evidence this time, but the grand finale, you could say, of the entire audit process, the auditor's report.
That's right. It's the destination, isn't it? After all that planning, all that testing.
All the risk assessment, evidence collection, it all leads here.
It truly does. I mean, we spend weeks, sometimes months, getting everything planned out, testing the controls, doing all those substantive procedures. And yeah, all that hard work really culminates right here in this final expression of our professional judgment. And for anyone studying audit and assurance, well, mastering this report structure, understanding the rules for issuing different opinions, it's absolutely crucial. It's really where the whole syllabus, comes together.
Absolutely critical. The exam definitely demands precision here. But maybe even more importantly, in the real world, that report, well, it's often the only thing that the external users actually interact with.
That's a great point.
The investors, the creditors, the shareholders, they might only look at that report. It summarizes all the credibility, the assurance that the auditor adds. It really is the moment of truth.
And that value proposition, that credibility, it really rests entirely on two sort of foundational pillars. We need to be clear. We are not providing a certification. It's not a guarantee of absolute accuracy.
No, definitely not.
What we're doing is expressing an opinion, and that distinction is just critical. And importantly, that opinion is only valuable, it's only marketable if it's independent.
Independence.
Independence is, well, it's the lifeblood of the entire profession. Honestly, without it, the opinion is pretty much meaningless to the capital markets.
That distinction, opinion versus guarantee, it's really worth spending a moment on. Why does the market accept just an opinion, knowing that, absolute assurance just isn't possible?
Well, it comes down to the inherent limitations of auditing itself. I mean, we work on a sample basis, right? We often have to rely on management representations for certain things, and let's face it, we operate under time and cost constraints.
Of course, practical realities.
Exactly. The audit risk model itself acknowledges that there's always going to be some residual detection risk. So by expressing an opinion, what we're saying is we obtained reasonable assurance, which is a high level of comfort, but not absolute, that the financial statements as a whole are free from material misstatement. It's really a pragmatic solution, manages that expectation gap.
Okay, perfect. So that opinion is formed on the financial statements as a whole. Let's quickly just confirm the exact components. What makes up those financial statements that we're actually giving an opinion on, usually under, say, the IFRS framework?
Right. So the scope of that audit opinion, it typically covers 5 key pieces of information. First up, the statement of financial position, the balance sheet.
Yep, got it.
Second, the statement of profit or loss and other comprehensive income, your P&L and OCI. Third is the statement of changes in equity that often explains some movements on the balance sheet itself.
Right.
Fourth, the statement of cash flows. Super important for assessing liquidity and, the operating health of the company.
Vital.
And fifth, and you could argue this is often the most informative part, the notes to the financial statements. That includes the summary of significant accounting policies.
You emphasize the notes there. Why? I mean, they often seem like, footnotes may be secondary to the main statements.
But they're anything but secondary.
Yeah.
The notes are absolutely essential because they provide all the context. You see, the primary statements tell you what the numbers are.
Okay.
But the notes tell you how those numbers were actually arrived at. Things like the valuation methods used for inventory, the useful life estimates for fixed assets, details of contingent liabilities, the specific accounting policies they've adopted. It's all in there.
So without that context, the numbers alone could be misleading.
Precisely. If the disclosures in the notes are inadequate, even if the main numbers, the primary figures, are correct, the financial statements simply won't present fairly.
Got it. And crucially, what's specifically excluded from the scope of that core audit opinion?
Yeah.
What are we not giving that true and fair verdict on?
Yeah, that's important too. The key documents usually excluded are things like the director's report, the chairman's statement, maybe any glossy sections talking about corporate social responsibility.
The front-end stuff, often.
Exactly. They're part of the wider annual report, yes, but they fall under what we call the other information umbrella. Now, the auditor does have a responsibility to read that other information and report if it materially contradicts the audited financial statements.
Okay.
But that information itself isn't covered by the core opinion that states the financial statements present fairly.
Right. So before we even think about modifying a report or even its final structure, we have to figure out if there's actually a problem big enough to even mention. And that whole decision funnel, it really starts and ends with one concept: materiality.
Bedrock concept.
Absolutely. This is the bedrock, isn't it? So let's unpack how materiality acts as that crucial filter for the auditor.
Okay. Well, materiality is entirely user-centric. That's the key. A matter is considered material if its omission or its misstatement or maybe even its misclassification could reasonably be expected to influence the economic decisions that the primary users make.
And primary users being?
Those existing and potential investors, lenders, other creditors, the people relying on those statements to make financial decisions. So basically, if a mistake wouldn't change a user's decision, it is, by definition, immaterial.
Right.
And the auditor shouldn't be wasting time reporting it.
Okay, so that example.
Yeah.
Company with $1 billion in assets finds a, say, $5,000 error in a utility bill, even though it's technically wrong.
Yeah.
It's not material. It won't move the needle for an investor thinking about a multi-million-dollar investment.
Exactly right. And that speaks to the quantitative aspect, the size. But, and this is important, the auditor must always apply professional judgment. You have to consider both the size and the nature of the item.
Size and nature.
Okay.
And this concept of materiality, it flows through absolutely everything, right from planning the minimum sample sizes you need during the audit, all the way through to evaluating that final list of errors you found at the end.
Now, for our listener, especially the ones focused squarely on the exam, those quantitative rules of thumb are pretty essential, aren't they? Even though they're just guidelines.
They're just guidelines, but yes, absolutely essential for exam purposes. They provide that necessary structure for calculating planning materiality.
So what are those key numerical benchmarks we need to know?
Okay, so we typically use percentages applied to a chosen base figure, usually something stable and predictable from the accounts. The common ones cited are not 0.5%, 0.5% to 1%, 1% of revenue. That's often used for companies with pretty steady operations.
Yeah, okay.
Then there's 1%, 1% to 2%, 2% of total assets. That's a common choice for maybe asset-intensive companies or perhaps those in a startup phase where revenue or profit isn't stable yet.
And finally, the one that gets a lot of attention. 5%, 5% to 10%, 10% of profit before tax.
Let's focus on that profit one for a sec. 5 to 10% sounds pretty robust, but profit can be really volatile sometimes, can't it? Especially for companies with cyclical operations or maybe those hovering near break-even. How does that volatility affect the auditor's choice?
That is a brilliant point. Profit before tax is an excellent benchmark in principle because users, particularly investors, are intensely focused on performance, on profit.
Understandably.
However, like you said, if the company is reporting a loss or if that profit figure swings wildly from year to year, then using that 5% to 10% benchmark becomes unstable, maybe even meaningless in some cases.
Which means the auditor has to step back, use their judgment.
Precisely.
And maybe pivot away from profit as the main benchmark.
Exactly. If profit is volatile or negative, the auditor is actually required to select a more stable benchmark. Often they'll revert to using total assets or perhaps even revenue. And crucially, the rationale for that choice, why they picked a different benchmark, must be documented in the audit file.
Okay.
And just as a side note, if you're auditing, say, a nonprofit entity, you might use something like total expenditure or total income instead, as profit isn't really their main operational goal, you see.
Right. That makes sense. So that covers the numbers, the quantitative side. But you mentioned the qualitative side of materiality, and that's often where the real surprises can lie, isn't it? When does a seemingly tiny error suddenly punch above its weight?
Yeah, this happens when the nature of the error is actually more important than the dollar amount.
Mm-hmm.
The classic example we always talk about is an error that's quantitatively small, let's say, just $8,000, but it manages to transform a reported loss of $5,000 into a reported profit of $3,000.
Ah, the break-even point crossover.
Exactly. This is qualitatively material because it creates what we call unfounded optimism. It might lead users to mistakenly believe the company has turned a corner, which could drastically influence their investment decisions, even though the amount itself is small.
Are there other qualitative factors that could make even small errors material, besides flipping profit loss?
Oh, absolutely. Errors involving fraud, particularly management fraud, are almost always considered qualitatively material regardless of the amount.
Why is that?
Because it speaks directly to the integrity of the financial reporting system and the effectiveness or lack thereof of internal controls. If management is overriding controls, that's a huge red flag.
Makes sense. What else?
Errors that cause a company to breach its debt covenants are also usually material. Breaching a covenant can trigger the immediate repayment of a large loan, which could have catastrophic consequences.
Right, immediate liquidity crisis, potentially.
Exactly. And finally, errors that affect the calculation of things like management bonuses or director remuneration, those are almost always material too, because they impact the fairness of disclosures required by regulations about executive pay.
Okay, that raises a practical question, though. If the auditor finds one of these small but qualitatively material errors, like the one that flips a loss to a profit,
Yeah.
wouldn't they just, push management hard to fix it, regardless of the opinion implication? Isn't correction the first step?
Oh, absolutely. That is the standard ethical approach and the first port of call. The auditor's primary goal is always to encourage management to correct all identified misstatements, even the ones they think are immaterial, just to get the financial statements as accurate as possible.
Okay.
The whole materiality framework and the impact on the audit report really only comes into play if management refuses to correct an error that the auditor believes is material.
So it's the refusal that triggers the reporting issue.
Precisely. If management refuses to adjust that $8,000 error that flips the profit loss, then the auditor must formally evaluate its materiality and decide if it requires a modification to the audit report. It only becomes a report issue when the correction fails.
That makes perfect sense. Okay, now let's connect this to performance materiality. That's a term we use during the audit planning phase, right?
Yes. Performance materiality. Think of it as an amount or amounts set at less than the overall financial statement materiality level. It's like building in a safety buffer.
A buffer. Why do we need a buffer?
Well, we set this lower amount because we know auditors work with samples, not the whole population of transactions. And there's always a risk that individually immaterial errors, maybe found across various different accounts, inventory here, receivables there, payables somewhere else, might, when you add them all up, aggregate to exceed the overall materiality level for the financial statements as a whole.
Right. So if our overall materiality for the whole set of accounts is, say, $100,000, we might set performance materiality lower. Maybe it's $60,000 or $70,000.
Exactly. Let's say we set it at $60,000.
Why that specific buffer? What's the thinking?
It's all about managing detection risk, the risk that our audit procedures won't catch a material misstatement. Imagine if every single audit segment, inventory, receivables, payables, was audited only up to that $100,000 overall limit.
Right.
And suppose each segment had an uncorrected error of, say, $30,000. Individually, they're well below the $100,000 limit.
Right.
But if you add them up, 30K plus 30K plus 30K, the total aggregate error is $90,000. Now, that's still within the individual testing limits used, but it's getting dangerously close to, or potentially even exceeding, the overall financial statement materiality of $100,000.
I see. The sum of the small parts becomes big.
Precisely. By setting performance materiality lower at 60K in our example, we force the audit team to be more precise, more thorough in their procedures for each segment. They have to find errors sooner. This reduces the likelihood that the aggregate of all those individually small, uncorrected misstatements will end up being material to the financial statements as a whole.
Okay, that clarifies performance materiality nicely. So once we've navigated this whole minefield of materiality, quantitative and qualitative, and we've determined which figures actually matter, what exactly is the auditor providing that final opinion on? The long-standing standard is this concept of true and fair.
Yes, true and fair. That's the ultimate conclusion we're aiming for in many jurisdictions. The phrase itself often originates from company legislation, and it really requires a dual assessment.
Dual assessment. Okay, break that down.
So true basically addresses the factual correctness of the numbers. Are the amounts actually supported by evidence? Are they mathematically correct? Do they reflect the underlying reality of the transactions? If the figures reflect reality and are free from material misstatement, they're generally considered true.
Okay, factual accuracy. And then there's fair, which you hinted earlier is maybe the more complex, more subjective concept.
It can be, yes. Fairness relates more specifically to the presentation and the disclosure. It's about ensuring that the commercial substance of transactions is properly reflected, and critically, that the presentation doesn't somehow mislead the user.
Mislead the user. How?
Well, for example, imagine a company sells goods but retains significant risks and rewards of ownership. Maybe they guarantee a buyback at a fixed price. Yeah. If they try to classify that transaction simply as a sale on the income statement rather than perhaps recognizing it as more of a financing arrangement, the numbers involved might be mathematically Correct, so true. But the presentation is unfair because it misrepresents the company's actual risk profile and financial obligations. It doesn't reflect the commercial substance.
Can you give us another strong example, maybe related to classification on the balance sheet showing unfair presentation?
Sure. Consider a company that's maybe a bit desperate to show strong short-term liquidity. They have some long-term investments, things they genuinely intend to hold for many years. But they decide to classify these assets as current assets on the balance sheet, simply because, technically, they could be sold within 12 months if they really had to.
But that's not the intention.
Exactly. The intention is long-term holding. So while the actual asset balance, the dollar value, might be correct, so true, the classification as current artificially inflates the current ratio. It distorts the user's view of the company's genuine ability to meet its short-term debts using readily available assets. That classification is unfair.
Right, that's a great example. Now, the ISAs, the International Standards on Auditing, they tend to simplify this slightly, don't they? They prefer the phrase, present fairly in all material respect.
That's right. That phrase, present fairly in all material respects, is the standard wording preferred by the IAASB, the body that sets the ISAs. However, it's really important to understand that for all practical application, and certainly in most legal jurisdictions that use true and fair, this phrase is considered functionally equivalent.
So, present fairly in all material respects essentially means the same thing as providing a true and fair view.
Largely, yes. The focus remains on both aspects. Accuracy, which is covered by true or in all material respects, and appropriate presentation and disclosure, which is covered by fair or present fairly. It's still that dual assessment.
Okay, so let's assume we've done all that work, navigated materiality, assessed true and fair, or present fairly, and we've concluded everything looks good. Now we issue an unmodified, or what's often called a clean report.
The desired outcome.
This is definitely the expected outcome in the vast majority of audits. It's the baseline structure, isn't it? The template from which all modifications deviate. So let's establish the mandatory components of a standard independent auditor's report.
Right. The structure is very highly prescribed by the ISA, specifically the ISA 700 series, and that's really to ensure global consistency and comparability. It makes it easier for users anywhere in the world to understand.
Good point. Where does it start?
It starts with the absolute basics, the title and the addressees. It must be prominently labeled Independent Auditor's Report, no ambiguity there. It instantly signals its purpose and its independent nature.
And the addressees, who is it actually for?
It must be addressed to the specific stakeholders who engage the auditor. Typically, for a company audit, that's the members, meaning the shareholders of the company.
Okay, title, addressees. Then what? Straight to the point.
Absolutely. Immediately after the title, we jump right to the conclusion. The opinion paragraph.
Opinion first. That seems counterintuitive, maybe. Usually build up to a conclusion.
It was a deliberate change made some years ago, actually. The idea is to make the report more user-friendly. Users, especially busy investors, want the bottom line immediately.
Get the answer first.
Exactly. So if the opinion is clean, unmodified, this paragraph will state clearly that the financial statements present fairly in all material respects. It will also identify the specific financial reporting framework used like IFRS or local GAAP, and the specific date or period covered by the financial statements that were audited.
And crucially, if the opinion is not clean,
then this paragraph gets renamed. It signals modification immediately. It would be headed qualified opinion, adverse opinion, or disclaimer of opinion, depending on the issue.
Okay, opinion first. Then logically, we need the justification. So the basis for opinion paragraph follows.
Correct. The basis for opinion section essentially validates the conclusion reached in the opinion paragraph. It confirms the rigorous standards that were applied during the audit.
What does it confirm specifically?
It asserts two main things. First, it states that the audit was conducted in accordance with International Standards on Auditing, ISAs. This gives the user confidence in the methodology, the quality control.
Right. The rule book we follow.
Yeah, precisely. Second, and this is absolutely vital, it confirms the auditor's independence. It explicitly states that the auditor is independent of the entity in accordance with the relevant ethical requirements, usually referencing the IESBA Code of Ethics for Professional Accountants. It also confirms that the auditor has fulfilled all their other ethical responsibilities like objectivity, integrity, professional competence, and due care.
So this is where the auditor really substantiates the core value proposition we talked about earlier, their independence.
Exactly. It's the bedrock assertion.
Okay. Moving on within the clean report structure,
Yeah.
we get to what is often, I think, the most insightful part for users these days, the Key Audit Matters section, or CAMS. You mentioned this is mandatory only for listed entities.
That's right. Currently mandatory primarily for audits of listed entities, although the scope can vary slightly by jurisdiction. The introduction of CAMS was a major step to add relevance and transparency to the audit report.
How so? What was the problem it solved?
Well, previously, a clean, unmodified opinion was just a binary signal. Basically, yes or no, thumbs up or thumbs down. It didn't give much insight into the audit process itself.
A bit of a black box.
Exactly. CAMs were designed to open a window into that black box. They highlight the areas of the audit that demanded the most intense attention and the most significant professional judgment from the auditor during the audit. It's partly a mechanism to combat the criticism that the standard audit report was becoming a boilerplate document that users often ignored.
So if I'm a user reading the report, the CAMS section essentially tells me where the auditors thought the biggest risks were, or where the most complex judgments lay.
That's precisely the idea. The official definition states that CAMs are those matters that, in the auditor's professional judgment, were of most significance in the audit of the financial statements of the current period.
And how are they determined? How does the auditor filter down from all the issues they looked at to just the most significant?
They are selected from matters that were communicated with those charged with governance, typically the audit committee. The auditor generally considers three main categories when identifying potential COMs.
Okay, what are those three filtering categories?
First, they look at areas that were assessed as having a higher risk of material misstatement, or areas identified as significant risks, according to ISA 315. These are inherently risky areas.
Right.
Second, they consider areas involving significant auditor judgments, particularly those relating to areas that also involved significant management judgment. Think about complex accounting estimates with high estimation uncertainty, like valuing goodwill after an acquisition, or provisioning for a complex lawsuit, or maybe valuing sophisticated financial instruments.
Lots of judgment on both sides there.
Exactly. And third, they consider the effect on the audit of significant events or transactions that occurred during the period. This could be something like a massive acquisition, a disposal of a major business segment, or perhaps a major restructuring program.
That sounds like potentially quite a few areas could qualify, especially in a complex business. How does the auditor avoid just listing every major account? How do they distinguish a routine high-risk area from something truly warranting a CAM description?
That is definitely the challenge, and it requires significant judgment. For instance, accounts receivable is always considered a high-risk area in most audits due to valuation concerns.
Sure, risk of bad debts.
Right. But the routine testing of receivables and the calculation of the expected credit loss provision, while important, wouldn't usually be a CAM in itself unless there was something uniquely complex or highly judgmental about it in that specific year.
Okay, so what would elevate it?
Maybe if there was a very specific, highly concentrated credit risk, with a single major customer located in a country undergoing sudden, severe political instability, and assessing the recoverability required unusual, highly subjective judgment and external expert input. That might elevate it to PAM status.
So it's about the significance of the judgment or risk in that particular audit.
Precisely. The auditor has to filter the list down to only the most significant matters for that specific year's audit.
Can you give us another clear contrast, maybe an example of a high-risk area that's typically not a COM versus one that often is?
Okay. A high-risk area, not typically a COM, could be the standard risk that inventory might become obsolete, requiring the routine application of net realizable value testing. It's high value, maybe high risk, but the procedures are often quite standard.
Routine NRV testing. Got it.
Right. Now, a high-risk area that is quite likely to be a COM would be something like the valuation of a complex, internally generated intangible asset, perhaps capitalized software development cost under IAS 38.
Yes. Always tricky.
Very tricky. That valuation relies heavily on forecasting future economic benefits, selecting appropriate discount rates, assessing technological feasibility, all involving highly subjective management estimates that require extensive auditor challenge and judgment. That complexity and judgment often elevate it to the level of significance required for a COM.
That's a great contrast. Now, there's a very important point, a caveat, about the CAM section when it comes to one specific type of modified opinion. The disclaimer of opinion.
Yes, absolutely crucial point. If the auditor has concluded that they must issue a disclaimer of opinion, meaning they couldn't obtain sufficient appropriate audit evidence to form any opinion on the financial statements as a whole.
The most extreme scope limitation.
Exactly. In that situation, the audit report must not include a key audit matters section.
And the logic behind that.
The rationale is quite straightforward. You cannot logically describe the matters of most significance during the audit if, by the very definition of issuing a disclaimer, the audit was fundamentally incomplete or compromised to the point where you couldn't reach an overall conclusion. Describing CAMs would imply a level of understanding and completion that simply wasn't achieved.
Okay, that makes sense. You can't highlight key findings if you couldn't properly complete the investigation. Right, let's move on to the responsibility sections in the report. We start with management's responsibilities. This seems crucial for managing that expectation gap we talked about.
It absolutely is. This section clearly lays out the fact that the financial statements are not the auditor's statements. They belong to management. Management is the party responsible for them.
So what does it specifically say management is responsible for?
It generally reiterates that management is responsible for 5 key areas. First, preparing the financial statements in accordance with the applicable financial reporting framework, like IFRS. Second, designing, implementing, and maintaining the internal controls necessary to allow for the preparation of statements that are free from material misstatement, whether due to fraud or error.
Preparation and control.
Yes. Third, selecting and applying appropriate accounting policies. Fourth, making accounting estimates that are reasonable in the circumstances. And fifth, critically important, assessing the entity's ability to continue as a going concern and making the appropriate disclosures if necessary.
It almost sounds a bit like a defensive paragraph from the auditor's perspective, clarifying, we didn't cook the books, they did.
Well, you could see it that way, but it's more preventative and educational, really. It clearly educates the user of the report about the distinct roles. If something does go wrong later down the line, say the company fails, the auditor can point back to the section and confirm that management owned the primary responsibility for the preparation, the controls, and the going concern assessment. It's definitely part of bridging that expectation gap that the public often has about what auditors actually do.
Okay, so that naturally leads into the next section.
Yeah.
The auditor's responsibilities. If management is responsible for all that, what exactly are we, the auditors, confirming we did?
Right. This section details our objectives. The primary objective is stated as obtaining reasonable assurance again, highlighting it's a high level, but not absolute assurance about whether the financial statements as a whole are free from material misstatement, whether that misstatement is due to fraud or error.
Reasonable assurance, not absolute. Key phrase.
Absolutely key. This section also confirms that the auditor exercises professional judgment and maintains professional skepticism throughout the audit. Furthermore, it typically outlines how the auditor achieves reasonable assurance by describing the key stages of the audit process.
Such as
Identifying and assessing the risks of material misstatement, designing and performing audit procedures responsive to those assessed risks, obtaining sufficient appropriate audit evidence, evaluating the appropriateness of the accounting policies used, evaluating the reasonableness of accounting estimates made by management, and importantly, concluding on the appropriateness of management's use of the going concern basis of accounting. It's effectively a summary of the entire audit cycle from the auditor's perspective.
Got it. A comprehensive overview of our role. Finally, we get to the more logistical components at the end. The date, the auditor's address, and the signature. Why is the date of the report considered so crucial that it merits specific focus in the syllabus and standards?
The date of the auditor's report. It's a really important legal demarcation point. It signifies the end of the auditor's active duty to search for and evaluate certain events.
Active duty, what does that mean?
It means that up until that specific date on the report, the auditor is actively required by auditing standards, like ISA 560 on subsequent events, to perform procedures designed to identify any events that occur after the company's year-end date, but before the date the auditor signs the report.
Okay, events in that gap period.
Exactly. These are known as subsequent events. And the auditor needs to consider if these events require an adjustment to the financial statements themselves, or perhaps just require disclosure in the notes to the financial statements to ensure fair presentation.
So, give me an example. If a major lawsuit against the company is settled for a large amount after the year end but before the auditor signs off, or maybe a factory burns down in that period.
Yes, those are perfect examples. The auditor must ensure that the financial implications and disclosures related to such events are properly treated or disclosed in the financial statements before they put that date on their report.
Okay, and what happens after that date is on the report? Does the auditor's responsibility just stop?
Not entirely, but it changes significantly. Once the report is dated and issued, the auditor shifts from that active duty to search for events into more of a passive duty.
Passive duty.
Yes. They are no longer required to actively perform procedures to look for subsequent events. They generally only have a responsibility to act if information about a subsequent event that existed at the date of the report and would have potentially changed their opinion is brought to their attention, perhaps by management or a third party.
So if a material fact comes to light, say, 6 months after the report was issued, the auditor is generally only responsible if they knew about it, or perhaps should have known about it based on their work before they signed the report on that specific date.
That's the general principle, yes. The date locks down the period of active investigation.
Okay, so we have the clean report structure nailed down now. But things aren't always perfectly clean, even when the main opinion remains unmodified. Now we enter the territory of, let's call them, nuances, additional paragraphs that flag serious issues, but, and this is crucial, they do not actually change that fundamental true and fair or presents fairly opinion.
That's a very important distinction to make.
We absolutely need to clearly separate these additions or emphasis paragraphs from the full-blown modifications we're going to discuss shortly. So let's start with arguably the most serious of these additions, the material uncertainty related to going concern paragraph.
Yes, this is an area of massive focus and scrutiny in the audit world, and rightly so, because it deals directly with the company's potential survival. The auditor has a significant responsibility here. We must critically scrutinize management's own assessment of the entity's ability to continue operating as a going concern for what's termed the foreseeable future.
And how long is the foreseeable future defined as?
The auditing standards, and often accounting standards too, specify that this assessment must cover a period of at least 12 months from the date the financial statements are approved, often the date the director signed them off, which might be slightly before the auditor signs their report.
Okay, at least 12 months out. What kind of red flags, what indicators would trigger the need for the auditor to consider adding this specific paragraph?
Oh, there are numerous potential indicators we look for. Things like repeated negative operating cash flows, the company breaching key debt covenants or loan agreements, an inability to secure necessary new financing or perhaps renegotiate existing facilities that are coming due, the loss of a major customer or maybe key management personnel who are critical to operations, or perhaps non-compliance with statutory or regulatory requirements that could threaten the company's license to operate. Any of these, or often a combination, could suggest a material uncertainty exists.
Okay, so the auditor identifies these indicators, does their work, and concludes that yes, a material uncertainty does exist. But, and this is the key condition, management has accurately and adequately disclosed all the relevant details about this uncertainty, the risks, their mitigation plans, everything, properly in the notes to the financial statements. What happens to the audit report then?
This is the critical juncture, the key distinction. If the auditor concludes a material uncertainty exists, but management's disclosure about it in the notes is adequate and appropriate according to the accounting standards.
So management has been transparent.
Yes, if the disclosure is good, then the audit opinion itself remains unmodified. It's still a clean opinion. Why? Because the numbers in the financial statements are presented correctly based on the going concern assumption, which management still believes is appropriate, albeit uncertain, and the critical risk disclosure is fair and complete.
Okay, clean opinion, but
because the risk of the company potentially failing is so fundamental, so profound for users' decisions, the auditing standards require the auditor to include a separate paragraph in the audit report immediately after the basis for opinion paragraph. This paragraph must have a specific heading, material uncertainty related to going concern.
So that paragraph acts like a big flashing warning light in the report, doesn't it? It's essentially saying, hey, user, the numbers here are presented fairly based on the going concern assumption, and management has told you about the risks in Note X, but be warned. The future is highly precarious, and you absolutely must read that Note X very carefully.
That's a perfect analogy, a flashing light. We are drawing mandatory attention to a very significant risk that management has correctly disclosed. The opinion isn't qualified because the disclosure is adequate.
Okay. But what happens if management's response to this going concern uncertainty is not adequate? Or if the situation is even worse?
Well, then the situation changes entirely, and we move away from just adding a paragraph to potentially modifying the opinion itself.
For example, if management refuses to make adequate disclosure about the dire situation, or, maybe worse, if the company is effectively insolvent already, and they really should have used a completely different basis of accounting altogether.
Right. Two scenarios there. First, if the auditor concludes a material uncertainty exists, but management's disclosure of it is inadequate, maybe they downplay the risks or omit key information.
Trying to hide it.
Essentially, yes. If the disclosure is inadequate, then the financial statements as a whole are considered materially misstated due to that inadequate disclosure. At that point, the modification matrix, which we'll get to, kicks in. It's a misstatement.
And the second scenario, if going concern isn't appropriate at all.
If the situation is so bad, maybe liquidation is unavoidable, that the going concern assumption itself is inappropriate, then the financial statements must be prepared on the breakup basis, or liquidation basis, if management wrongly continues to use the going concern basis.
Then the whole set of accounts is fundamentally flawed.
Exactly. The underlying basis of accounting is fundamentally wrong. That constitutes a material misstatement, and because it affects so many figures and the overall presentation, it would almost certainly be deemed pervasive. This would typically lead to an adverse opinion.
Okay, that provides a really clear line between just adding a material uncertainty paragraph when disclosure is adequate and moving to a modified opinion when disclosure is inadequate or the basis is wrong. Great, but let's move to the other two key types of additions. The emphasis of matter, EOM paragraph, and the other matter OM paragraph. Students often get these two confused. Let's clarify the boundary, starting with emphasis of matter.
Okay, the emphasis of matter, or EOM paragraph, its purpose is to draw the user's attention to a matter that is already properly presented or disclosed within the financial statements themselves.
So the information is in the accounts or notes already.
Yes, properly disclosed. But the auditor considers the matter to be so important, so fundamental to the user's understanding of the financial statements, that they want to highlight it specifically in the audit report, even though the auditor believes the financial statements, including this matter, are true and fair overall.
Okay. Can you give us a couple of distinct examples of when an EOM paragraph might be used?
Sure. A common example relates to significant uncertainty regarding the future outcome of exceptional litigation, where the potential outcome is properly described and quantified as best as possible in the notes. Another could be a major catastrophe that happened after the reporting date but before the audit report was signed, like the major fire we mentioned earlier that destroyed a factory. If it's a non-adjusting event but is fully disclosed in the notes, an EOM might highlight it.
So a key feature seems to be that the EOM paragraph points inward, towards something specific within the financial statements or their notes.
Absolutely. That's the defining characteristic. It highlights something already disclosed. And crucially, just like the going concern paragraph, the EOM paragraph must explicitly state that the audit opinion is not modified in respect of the matter being emphasized. It reassures the reader. We think this is really important for you to read, but it doesn't make the overall financial statements misleading.
Okay, EOM points inward to disclosed matters. So if that's EOM, where does the other matter, or OM, paragraph point?
The other matter paragraph points, in a way, outward or relates to the audit context itself. Its purpose is to communicate a matter other than those presented or disclosed in the financial statements that, in the auditor's judgment, is relevant to the user's understanding of the audit, the auditor's responsibilities, or the auditor's report itself.
Okay, something relevant but not in the accounts. Give us some typical scenarios where an OM paragraph would be appropriate.
Probably the most frequent use relates to comparative information or previous periods. For instance, if the prior period financial statements, which are presented for comparison, were audited by a different auditor, a predecessor auditor.
Right.
Or perhaps if the prior period financial statements were not audited at all. This fact is relevant to how a user might interpret the comparative figures in the current year's audit report, but it's not something disclosed within the current year's balance sheet or P&L notes themselves.
That makes sense.
Really?
Providing context about the audit scope or history.
Exactly. Another common use, which we touched on earlier, is in relation to that other information that's included in the company's annual report alongside the financial statements, things like the director's report or chairman's statement.
Right, stuff outside the main opinion scope.
Yes. If the auditor reads that other information, as they are required to, and discovers a material inconsistency between something said in the director's report and what's shown in the audited financial statements, they might use an other matter paragraph to draw the user's attention to that contradiction. Since the director's report itself isn't covered by the main audit opinion, the OM paragraph is the appropriate place to flag such an issue related to it.
Okay, this feels like the critical application section now. We're moving beyond additions and into situations where the auditor cannot give that clean, unmodified opinion. This is where the modification matrix comes in, and honestly, for exam purposes and real-world practice, this is the ultimate framework, isn't it? It links the problem discovered during the audit to the specific type of modified report wording.
Absolutely essential framework. You really need to understand this inside out. Modified opinions basically arise from two potential root causes, combined with two possible degrees of seriousness. That gives us our four potential outcomes.
Perfect breakdown. Let's start with the two root causes. Cause number one.
Cause 1. Material misstatement. This means the auditor has gathered sufficient appropriate evidence and concludes that the financial statements, taken as a whole, are materially misstated.
And misstated could mean?
It could mean the figures themselves are wrong, the presentation is misleading, like that classification example, the disclosures are inadequate, or perhaps management has misapplied the relevant accounting framework, like using the wrong IFRS standard or applying it incorrectly. Essentially, the auditor disagrees with management's accounting treatment or disclosure, and the disagreement is material.
Okay, disagreement on facts or application. Cause number 2.
Cause 2. Limitation on scope. This is officially termed an inability to obtain sufficient appropriate audit evidence. Here, the issue isn't necessarily that the auditor knows something is wrong, it's that they couldn't get enough evidence to conclude whether it's right or wrong.
So they're blocked somehow.
They could be. The auditor might have been physically or technically prevented from performing necessary audit procedures. This could arise from a restriction imposed by management. Maybe they won't allow access to certain records or locations. Or it could be due to circumstances beyond anyone's control, like the company's accounting records being destroyed in a fire or being fundamentally inadequate to start with. The bottom line is the evidence locker is partly empty for a material area.
Okay, 2 causes. Material misstatement, disagreement, or scope limitation. Lack of evidence. Now, for the 2 degrees of seriousness, this is what really determines whether the opinion is qualified, adverse, or a disclaimer. Degree number 1.
Degree 1. Material but not pervasive. This is the lower level of seriousness, relatively speaking. The problem, whether it's a misstatement or a scope limitation, is material, meaning it's significant enough that it could influence a user's decisions. But it's considered not pervasive. This means the issue can be isolated. It's confined to specific elements, accounts, or items within the financial statements. The problem is significant, yes, but the rest of the financial statements, the parts unaffected by the issue, are still considered to present fairly. We can effectively draw a boundary around the specific problem area.
Okay, material but contained. Degree number 2.
Degree 2, pervasive. This is the highest degree of seriousness. A problem is pervasive if its effects on the financial statements are not confined to specific elements or accounts, or if they are confined, they represent such a substantial proportion of the financial statements that they fundamentally undermine the usefulness of the statements as a whole.
So it contaminates the whole picture.
Essentially, yes. Or, alternatively, an issue can be deemed pervasive if it relates to disclosures that are absolutely fundamental to the user's understanding of the financial statements. The classic example here being issues around the appropriateness of the going concern assumption. If that's wrong, it tends to affect everything.
We probably need to be quite precise about that term pervasive, though. The ISAs have specific criteria, don't they? It's a high-stakes term to use.
Absolutely. You don't label something pervasive lightly. The ISA criteria essentially define a misstatement or a scope limitation as pervasive if one of 3 conditions is met. First, if its effects are not confined to specific elements, accounts, or items, it's widespread.
Okay.
Second, if the effects are confined to specific elements, but those elements represent a substantial proportion of the financial statements. Think about a scope limitation on verifying, say, 70% of total assets. Even if confined, its size makes it pervasive.
Right, it overshadows everything else.
Exactly. And third, if the issue relates to disclosures that are considered fundamental to the user's understanding of the financial statements, like we said, the appropriateness of the going concern basis, or maybe a complete failure to provide adequate disclosures about major uncertainties.
That detailed definition is extremely helpful. Okay, we have the 2 causes. Misstatement, scope limit, and the 2 seriousness levels. Material but not pervasive. Let's map the 4 outcomes using the matrix logic.
Right, let's build the matrix. First scenario. The cause is a material misstatement, And the seriousness level is judged to be material but not pervasive. What's the outcome?
That results in a qualified opinion.
Correct. And the specific wording used in the opinion paragraph is key here. It will typically say something like, in our opinion, except for the effects of the matter described in the basis for qualified opinion section, the financial statements present fairly.
Okay, so the auditor is saying everything looks okay except for this one specific detailed error we're about to explain.
Precisely. Now, second scenario. The cause is still a material misstatement, but this time the auditor judges its effects to be pervasive.
Pervasive misstatement. This is the big disagreement.
This leads to an adverse opinion. This is the auditor's strongest possible statement of disagreement. The opinion paragraph will state clearly that because of the significance of the matter described, the financial statements do not present fairly.
Do not present fairly. Very direct.
Very direct. It's essentially saying the financial statements as a whole are misleading. Okay, third scenario. Let's switch to the second cause. Lack of evidence. Scope limitation. The auditor couldn't get enough evidence, but they judged the potential impact, if there were errors, would be material but not pervasive.
Scope limitation, material but confined. What's the result?
It also results in a qualified opinion, just like the material but not pervasive misstatement.
Same outcome. Qualified.
Same outcome title. Qualified opinion, yes. But the wording in the opinion paragraph and the basis paragraph is subtly different and very important. Because we lack evidence, we can't say for sure there is a misstatement, so the wording will be something like, in our opinion, except for the possible effects of the matter described in the basis for qualified opinion section.
Possible effects. Because you don't know for sure due to the missing evidence.
Exactly. We couldn't confirm the true state of that specific account or area. And finally, the fourth scenario. The cause is lack of evidence, scope limitation, and the extent of the limitation is judged to be pervasive.
Scope limitation is so bad it affects the whole picture.
This leads to a disclaimer of opinion. The auditor simply cannot form an opinion.
So what do they say?
They must explicitly state in the now renamed disclaimer of opinion paragraph, because of the significance of the matter described in the basis for disclaimer of opinion section, we have not been able to obtain sufficient appropriate audit evidence to provide a basis for an audit opinion. Accordingly, we do not express an opinion on these financial statements.
We do not express an opinion. The ultimate non-conclusion, signifying a fundamental failure to achieve reasonable assurance.
That's exactly what it signifies. The audit objective could not be met.
All right, we've got the theory, we've got the matrix. Now let's really cement these concepts by walking through some clear, detailed scenarios for each of those four outcomes. This is where the application truly locks in for students, I think. Let's start with a qualified opinion resulting from a material misstatement.
Okay, good plan. Let's imagine the scenario. During the audit, we discovered that management has failed to depreciate a significant category of their property, plant, and equipment, let's say specialized machinery.
Why haven't they? What's their argument?
Their argument is that in the current strong economic climate, the market value of this machinery is actually increasing, so they believe depreciation isn't necessary this year.
Okay, but that's not how accounting standards work, is it?
No, it's a clear misapplication of IAS 16, property, plant, and equipment. IAS 16 requires the systematic allocation of the depreciable amount of an asset over its useful life, regardless of short-term market value fluctuations, unless specific revaluation models are properly applied, which they haven't done here.
So it's a definite misstatement. The auditor challenges this, explains IAS 16, but management digs in its heels and refuses to make the adjustment. What's the next step? Pervasive or just material?
We need to quantify the effect and assess its pervasiveness. Let's say the required depreciation charge that management has emitted amounts to $1.5 million. This $1.5 million emission overstates both profit before tax and the carrying amount of PPE on the balance sheet.
Okay. How does that compare to materiality?
Let's assume our overall financial statement materiality was calculated at $1 million. The $1.5 million misstatement is clearly material. 1.5 meters, $1.08 meter.
Material, yes. But is it pervasive? Does it taint the whole set of accounts?
This is where judgment comes in. The misstatement directly affects the PPE balance and the depreciation expense line item, and consequently profit and equity. However, let's assume the auditor was able to verify all other major balances, cash, inventory levels, receivables, debt balances, revenues, and found them to be fairly stated.
So the error is kind of quarantined.
Exactly. The impact is isolated to specific accounts. It's quantifiable. It doesn't fundamentally destroy the usefulness of the rest of the financial statements. Therefore, the auditor concludes the misstatement is material, but not pervasive. This leads directly to a qualified opinion.
And the report wording would clearly state something like, in our opinion, except for the impact of the failure to record depreciation on specialized machinery, as described in the basis for qualified opinion section, which has resulted in assets and profit being overstated by $1.5 million, the financial statements present fairly.
Precisely that kind of wording. The user knows the exact impact and can mentally adjust for it while trusting the rest of the picture is reliable. Okay, let's switch gears. Scenario 2. A qualified opinion, but this time due to a scope limitation.
Okay, scope limitation leading to a qualification. What's the scenario?
Let's use a common one. The auditor was appointed quite late in the year, perhaps 3 months after the company's financial year end.
Ah, so they missed the year-end inventory count.
Exactly. They were consequently unable to attend the physical inventory count at the year-end date. And let's assume inventory represents a material balance on the company's balance sheet.
Right. Missing of the count is a problem. Can't they do other work to compensate?
They absolutely must try. Auditing standards require them to attempt alternative procedures, so they might try to observe inventory counts happening now and roll the figures back to the year-end. They might try testing subsequent sales of year-end inventory to see if it's sold for more than cost. They could trace post-year-end purchase invoices for goods received just before year-end.
But what if those alternatives don't work?
That's the issue here. Let's imagine the company's internal controls over inventory tracking are quite weak. Maybe the perpetual inventory records are unreliable, and the documentation trail for sales and purchases around the year-end is incomplete or messy. The auditor concludes that, despite their best efforts with alternative procedures, they simply cannot obtain sufficient appropriate evidence to confirm the inventory carrying amount at the year-end.
Okay, definite scope limitation on a material balance. Why is this likely to be qualified rather than a disclaimer?
We assess pervasiveness again. The limitation is clearly confined to one major area, the inventory balance on the balance sheet, and consequently the cost of sales figure on the income statement. Let's assume the auditor was able to obtain sufficient evidence for, say, 90% of the company's other assets and liabilities. They could verify cash, accounts receivable balances, long-term debt, payables, fixed assets, etc.
So again, the problem is material but contained.
Yes, because the limitation's impact is isolated primarily to inventory and cost of sales, and the rest of the financial statements are deemed reliable, the auditor can confidently issue a qualified opinion. The key difference is the wording.
What would it say?
It would state something like, in our opinion, except for the possible effects of the matter described in the basis for qualified opinion section related to inventory, the financial statements present fairly. That phrase, possible effects, signals the uncertainty caused by the lack of evidence for that specific area.
Got it. Qualified for misstatement says, except for the effects. Qualified for scope limit says, except for the possible effects. Subtle but crucial. Okay, now for the really serious opinions. Let's tackle the adverse opinion, which arises from a pervasive misstatement. Let's use that severe going concern failure example we touched upon.
Right. This is where things are fundamentally wrong. Our scenario. We're auditing a highly leveraged company. During the year, it breaches its primary debt covenants with its main lender. Worse still, its main operating license gets revoked by the industry regulator. And to top it off, its largest customer, accounting for maybe 60% of revenue, has terminated their contract effective immediately.
Wow, that sounds like a perfect storm. Survival is clearly in doubt.
Absolutely. Management is now actively scrambling, trying to find potential buyers for the company's assets or business lines. However, despite all these catastrophic events casting extreme doubt on the company's ability to continue operating, management insists on preparing the financial statements using the standard going concern basis. They're valuing assets at historical cost less depreciation, not considering liquidation values, and they provide only minimal, perhaps misleadingly optimistic disclosure about the severity of their distress in the notes.
So the auditor concludes that the going concern assumption itself is inappropriate.
Yes. Based on the overwhelming evidence, the auditor concludes the company is not a going concern. Therefore, the financial statements absolutely should have been prepared on the breakup basis or liquidation basis of accounting.
And what does the breakup basis entail?
It's a completely different accounting model. It typically requires assets to be written down immediately to their estimated net realizable value, what they could actually be sold for in a forced liquidation, which might be much lower than cost. It requires recognizing provisions for closure costs, employee termination benefits, contract cancellation penalties, etc. And it usually requires reclassifying all non-current assets and liabilities as current because the long-term operating perspective is gone.
Okay, so using the going concern basis when the breakup basis is required, that affects pretty much everything, doesn't it? Asset valuations, liability recognition, classification.
Exactly. The failure to use the appropriate basis of accounting means the misstatement isn't confined. It permeates nearly every major balance sheet and income statement item. The asset valuations are likely materially overstated, liabilities understated, and the overall presentation is fundamentally misleading about the company's true financial position and performance, or lack thereof.
So, applying our matrix logic, this misstatement is clearly pervasive.
Highly pervasive. It meets the ISA criteria because it's fundamental to the user's understanding, and it affects the financial statements as a whole. The figures presented under the going concern basis are just not relevant or reliable in this context. Therefore, the auditor must issue an adverse opinion.
And the wording is blunt.
Very blunt. The opinion paragraph will state explicitly something like, in our opinion, because of the significance of the matter discussed in the basis for adverse opinion section, the inappropriate use of the going concern basis, the accompanying financial statements do not present fairly. It's a direct rejection of the statement's overall reliability.
Okay, adverse opinion locked down. That leaves us with the final and perhaps rarest outcome, the disclaimer of opinion resulting from a pervasive scope limitation. When does the lack of evidence become so bad that the auditor just throws up their hands?
This is reserved for truly exceptional circumstances where the limitations on obtaining evidence are so widespread, so significant, that they compromise the auditor's ability to form any sort of conclusion on multiple material areas, effectively obscuring the overall financial picture.
Can you give us a scenario, maybe combining problems?
Yes, often it's due to multiple interacting limitations. Let's revisit our late appointment scenario, where the auditor missed the year-end physical inventory count. That's one scope limitation. Now let's add another major problem. Imagine that simultaneously, during the financial year being audited, the client migrated to a completely new, bespoke, and unfortunately unstable core computer system.
No, dear. Data integrity issues.
Massive data integrity issues.
Yeah.
Let's say the migration was chaotic, data was lost or corrupted, and the new system has produced unreliable, often irreconcilable, records for crucial areas like accounts receivable, accounts payable, and maybe even sales revenue figures for large parts of the year. Management cannot provide reliable supporting documentation for these balances either.
So the auditor can't verify inventory due to the missed count and poor records.
Yeah.
And they can't reliably verify receivables, payables, or sales because the system records are a mess.
Exactly. Now you have significant scope limitations affecting major asset balances, inventory and receivables, major liability balances, payables, and key income statement figures, sales and cost of sales via inventory. The auditor simply cannot get comfortable with huge chunks of the balance sheet and P&L.
So the limitations aren't confined to one area anymore.
No, they're widespread. They arguably represent a substantial proportion of the financial statements. The auditor simply cannot obtain the sufficient appropriate audit evidence needed to provide reasonable assurance about the financial statements as a whole. They cannot conclude whether the statements are fairly presented or if they are not fairly presented. The fog is too thick.
And the result is?
The result must be a disclaimer opinion. In the disclaimer of opinion paragraph, the auditor must clearly state, as we noted before, because of the significance of the matters described in the basis for disclaimer of opinion section, we were unable to obtain sufficient appropriate audit evidence to provide a basis for an audit opinion. Accordingly, we do not express an opinion on these financial statements. It's a formal statement of non-conclusion. #tag outro.
Wow, okay. That has been an intensive, but I think incredibly necessary deep dive into the language, the structure, and the critical decision framework that defines the auditor's final product, the report. So just to quickly recap the key takeaways.
Yeah, let's summarize.
The absolute foundation is understanding that structure of the clean, unmodified report. You need that baseline clear. Opinion paragraph comes first for clarity, followed by the robust basis for opinion section confirming independence and adherence to ISAs. Then, for listed companies, the GARM's providing insight into the risk focus. And always that clear separation of management's responsibilities versus the auditor's responsibilities.
Absolutely. And crucially, remembering that those report additions are not the same as modifications. The material uncertainty related to going concern paragraph, the emphasis of matter paragraph, and the other matter paragraph, they all serve to draw critical attention to important risks or context.
Highlighting things.
Exactly, highlighting things without invalidating that core true and fair or presents fairly opinion, provided, of course, that management's underlying disclosure for those issues is adequate. That's the key condition.
But the absolute must-know, the essential tool for future application, whether you're facing a tricky exam scenario or wrestling with a difficult client situation in practice, it has to be that modification matrix.
Couldn't agree more.
Linking the two root causes material misstatement or scope limitation to the 2 degrees of seriousness material, but not pervasive or pervasive. Getting that logic right dictates the precise opinion outcome. Qualified, adverse, or disclaimer. You just have to be able to apply that matrix reliably.
And perhaps tying this all back to the very start of our conversation today. Remember, we stressed that the entire value of the audit, the reason the market relies on these reports, is built on the foundation of independence.
Yes, back to independence.
We detailed how the basis for opinion section explicitly confirms the auditor's adherence to the code of ethics. So maybe here's a final thought, a challenge really, for you to consider as you move into professional practice or even just deeper study. The integrity of that clean opinion, or indeed any opinion, hinges entirely on the auditor's ethical resilience. Now, given that we know the highest risk of material misstatement often comes when management deliberately overrides controls, perhaps for fraudulent purposes, how does an auditor practically ensure that their ethical independence, both their perceived independence and their actual independence in mind, remains absolutely ironclad? Especially when faced with pressures or threats, maybe intimidation from management, or even the subtle threat posed by high audit fees from a dominant client. How do you maintain that integrity? Because ultimately, that independence is what makes the opinion you've just learned to draft truly meaningful and trustworthy.
That is an excellent challenge, and a vital one. The technical mastery of the report structures and the modification matrix is absolutely essential, but it's almost useless without that underlying ethical foundation, that independence to stand upon. Well, we strongly encourage you, our listeners, to take all these concepts, the structures, the additions, the matrix, and apply them immediately. Get into those practice questions, work through scenarios, really solidify your ability to identify the cause, assess the severity, and pinpoint the resulting opinion.
Definitely practice is key here. And just a reminder for anyone looking to build further on this knowledge or perhaps find more structured support and resources for your ACCA studies, please do make sure you explore the other SmartPass study resources. You'll find links available in the description below this recording. And of course, we'd invite you to subscribe to the SmartPass YouTube channel for much more expert guidance and exam-focused content like this.
Absolutely. Well, that concludes this deep dive into the Auditor's Report. Thanks for joining us, and we'll catch you on the next one.